Well, stock traders have dividends and bond traders have coupon rates, but Forex traders have swap rates or interest on their currency positions. Now, this can be a bit of a surprise, actually, for new currency investors who weren't aware that this actually happens. But it's pretty easy to explain, and it's even easier to look at how is it really playing out in my portfolio. And there's even strategies that are based on the fact that swap or interest is being paid or charged on your Forex positions. So the best way to explain this is to look at a specific example and talk about why there's interest being charged on one side of that position and being paid on the other side of that position. So let's take a look at the Aussie dollar. Now, this is a good example right now because it's fairly dramatic. It used to be even more dramatic, actually. The Aussie dollar, when you buy the Aussie dollar exchange rate, in essence what you're doing is you're long the Aussie and you're short the US dollar. So, because what you're hoping to do, and in a way you could look at it like this, I sold some US dollars, so I more or less borrowed those, to buy and hold the more value, or the asset that I expect will become more valuable. I'm long the Aussie dollar, so I'm long the base currency. Now, if we borrow money, we're going to have to pay something on that, right? And if we own money, we're probably going to get paid interest on that if it were a deposit, wouldn't we? So what happens is that their interest rates are not equivalent from one economy to the next. Here's an example. We have the Aussie at around 4%. Now that's their benchmark interest rate. That's the interest rate set by their central bank. We have this similar situation here on the US dollar with 1% interest. So if you were to look at this as representative of the interest that you would be charged for borrowing dollars and that you'd be paid for owning and depositing Aussie dollars, then you've got a differential here. You're being charged this, but you're earning that, right? So here's what happens. If you're long the Aussie dollar exchange rate, then you get paid a small premium, so you get paid swap. Now, in this case, if you're long, you'd be paid, I think right now the swap rate is just under 1 pip, which means that per lot. So if you owned a full-size lot, that means you're being paid about $9.50 a day in swap. So we'll take a look at it like this. So $9.50 a day, that's almost a full pip that you're being paid every day to hold one long position in swap. Now, what about if you're short? What's going on there? Well, if you're short, then things change just a little bit, but they look very similar. So if you're short this particular currency pair, then everything's shifted here a little bit, hasn't it? Because now you're anticipating that the dollar is going to strengthen. You're looking for that currency rate to start to drop, which means that you're now long the dollar and short the Aussie if you're shorting that particular currency pair, which means that you're now borrowing the Aussie and holding the dollar. Now this differential at that point is working against you. So now no longer are you making a swap rate, you're paying a swap rate, and it's going to be, usually it's a little bit more, you pay a little bit more than you would make if you were on the other side of the transaction. That's totally normal. So you're probably being charged somewhere, let's say $10.50 a day, or just over 1 pip a day to hold a full-size lot. And if you were holding 3 lots, it'd be 3 times this. If you were holding half a lot, it'd be half of this. So you can see the idea as to how this actually plays out. Now, swap is, it's pretty easy to understand, and you can see on your total positions. So when you're looking at the MetaTrader 4 platform, you can see there's a column in the terminal under the trade tab for swap. So you can see how much have I made, and it nets out into your overall profits. But this goes beyond that, actually, because there are a lot of strategies that are built around the fact that swap even exists. And one of these strategies is talked about all the time. So even if you don't want to trade it, it's something that's useful, very useful to know about. So let's talk about that next. So you've probably heard this expression quite a bit as traders, reporters, analysts, etc. are talking about traders are moving into the carry trade, or they're unwinding the carry trade, or whatever it is. These are typically long-term positions that are based on this interest differential. There's a classic example, actually. For several years, since the early 2000s, traders would buy the pound yen. So they buy that particular currency pair because there's a very high interest rate available on the pound, very low interest rate available on the yen. So when they would buy those and they were long the pound, short the yen, what they were essentially getting is they were harvesting that interest differential for years at a time. Now, it's critical to know that, I mean, that's not a bad strategy. It sounds like a pretty good strategy. It's something institutional players trade all the time. So the carry trade, very popular. But like all strategies, you really have to understand, well, is it working now? When is it working? When should I deploy it? So you really have to understand your technicals, your fundamentals to know that, well, right now the carry trade looks pretty good, or right now I don't want to play it. I'm going to look for other currencies that are offering different kinds of opportunities I'm a lot more confident about. Another version of this, by the way, is that traders will accumulate a carry trade portfolio. So they may be long several high interest bearing currencies like the Aussie, the Kiwi, and even some more unusual crosses like recently the Krona has been one of those categories, and they'll be short the yen, they'll be short the franc, some of these low yielding currencies on the other side. And what they're trying to do is to diversify out their portfolio, not get too leveraged, but diversify this out so they're taking advantage of several different currency pairs and not just concentrating on the euro yen or the pound yen like many traders did over the last few years. So this is something to keep in mind, as this is a potential strategy. So if the markets are operating fairly normally, especially if it's a more bullish or growth environment, the carry trade performs really well. And it's one way to apply this concept of swap or interest in the Forex. Conversely, when global growth is really constrained, recession or things like this, then the risk environment changes and the carry trade, which is in and of itself a fairly risky position, becomes much less desirable and doesn't perform very well at all. So learn how to apply these things in the proper market environment, but this is, I think, a great example of how to apply one concept that exists in the Forex to a trading strategy. Now, I always give this tip when we talk about complicated subjects like interest or swap. Take a minute, review the video, review what we've written down, and until you feel comfortable with it, go explain it to someone else. There's no way to learn that's better than trying to teach somebody else. So grab a captive audience, a family member or a good friend who will put up with you, and explain to them how this works and let them ask you questions. If you can explain it to somebody else, you really understand it and you're ready to apply it in your own trading portfolio. Now, there's one last thing I would mention about interest or swap in the Forex, because it is kind of a unique thing. Well, it gets even a little bit more unique about midweek on Wednesday. So in the Forex, you'll notice that if you're holding a position over Wednesday, your swap charge or credit, so that debit or credit to your account, depending on which side of a transaction you're on, triples on Wednesday. Well, that's because the market is essentially closed on Saturday and Sunday, so those 2 days are wrapped up into Wednesday. But there's nothing to be concerned about. It just means that if you're on the right side of that transaction, so you're getting paid swap, Wednesday's a pretty good day. If you're on the other side, so if you're paying swap, if it's being taken out of your account, Wednesday's a little bit rough, so you better hope that that transaction's going the way that you forecasted that it would. But just one more thing to keep in mind, so you don't get caught by surprise on those Wednesdays when the charge or credit looks a lot bigger than it would otherwise.
This video has been brought to you by Alpari.